What I want to focus on today is the demand for money, how the interest rate is determined, so the money market equilibrium, and monetary policy instruments. Starting with the first part, which is demand for money. You can think of money as an asset that's very liquid, something that you can use for transactions, so you can use as means of payment. But in the same time, it doesn't pay you any interest in return. So what we can call money here is, or goes beyond just notes or coins. It actually also includes demand deposits or the current account deposits, things that you can use for transaction. And that means we could have different definitions of what we mean by money. Don't think of money as the cash or the notes you hold in your wallet. Money also includes so many things beyond that. That's why we have different definitions of money. Narrow money, which includes notes, coins, and demand deposits, and this in the UK is called M0. In other countries, might be like coins and notes are defined as M0. If you add demand deposits, that will give you M1. So if you add other time deposits, that will give us the broad money, or what we call the broad money. But at the end of the day, we understand that, okay, money is a very liquid asset. So liquid here, or liquidity here, means that you can use in transactions. When you define money, you're moving from the narrow definition to the broad definition based on how liquid that is. So starting from notes and coins, this is the most liquid form of money. Then moving toward demand deposit or current account deposit, okay, that's still more liquid than time deposits. As you move to the less liquid form of money, that will move us toward the broad definition of money. We know that, okay, money pays no interest rate, so you don't earn or you don't receive any interest rate if you hold money. But at the same time, it is fully liquid asset, which means that you can use it to make payment in no time and without losing its value. On the other side, bonds, which could be another alternative or another form in which you can hold your financial wealth. Bonds pay positive interest rate. So when you hold bonds, you receive interest rate. On the other side, it can't be used for transactions. So you can't use bonds to buy goods and services. Okay, so it is not liquid like money. Money and bonds as kind of alternatives or some different forms that we can store our financial wealth in. That's why we broadly define into two sub-markets, money markets and bonds markets. Money market is important. It's important for us to understand and study money market because central banks implement their monetary policy by actually changing the supply of money. So if they want to follow an expansionary monetary policy, so that means they need to, or they would be aiming to increase money supply. If they want to follow or apply a contractionary policy, then that means they will reduce the supply of money. This is a very important segment or component in the economy, and bonds market where interest rate is determined. So it's very important for us to understand how interest rate is determined, especially at the end. You will see here today that interest rate is also one of the policy instruments that central banks use to set their monetary policy. As I said before, so let's just think of these two as two different forms in which you can store your financial wealth. So we'll assume that financial wealth is split between money and bonds, and we understand these are not perfect substitutes, and we understand the differences now. So we know that, okay, money is more liquid than bonds, but money pays no interest while bonds do. Because we understand that equilibrium in one market implies equilibrium in the other market, we will focus mainly today on money markets. When we talk about money markets, just think of money as a good. How the price of money is determined in the market. So basically, you have demand and supply. If we understand the demand side and the supply side, then this will help us to understand the equilibrium in the money markets. First, which is the demand side, the question is, why do we need money? There are three reasons people demand money. One, which is the most obvious reason why you want money, is because of transaction demand. So basically, you want to make payments, you want to buy goods and services, and obviously this component or this factor is positively related to your income, meaning if income in the economy has increased, so that means more transactions, that means more demand for money because of transaction. So this is positively related to income. So this is one reason. The other reason is precautionary demand, just to face uncertainty. And this part or this component or this factor is negatively related to the interest rate. Just think of the interest rate here as the opportunity cost of holding cash. If you hold money, that means you're losing the interest rate you would have received if you decided to hold bonds rather than money. In that case, we would imagine that there's kind of negative relationship between the precautionary demand and interest rate, because interest rate is the opportunity cost of holding money. The third reason, which is the speculative demand. So sometimes they said we can spend or we can invest on interest bearing assets like bonds, and you would imagine that this relationship is negatively, so speculative demand for money is negatively correlated with interest rate. When there's high interest rate, that means or implies that low bonds price, which means, as I said before, the cost or the opportunity cost of holding money is higher, again, just because money doesn't pay you interest. So you wouldn't receive interest when you hold money. Remember, we split the financial market into money market and bonds market. We said we want to focus on the money market, and to understand the equilibrium in the money market, you just need to understand both sides, demand for money and money supply. If we understand what determines these two sides, then it'll take us to the equilibrium. So far we're looking at the demand for money. The demand for money now, from what we said now, so we talked about three reasons: transaction demand, precautionary demand, speculative demand. So the transaction demand, this is positively related to income. So nominal income, think of it as a measure of the level of transaction in the economy. So as I said before, if at a higher income level, so you would imagine that there are more transactions, and that means more demand for money because of that reason. So that's positively related to demand for money. And the other factor here is interest rate. It's a decreasing function of interest rate, meaning that when interest rate is high, then there's lower demand for money, kind of going opposite direction. Represent this as this function here. So MD here is the demand for money. And we have two components here, or two factors here. This sign dollar, we explained in the first lecture, whenever you see sign dollar before Y, that means this is nominal income. And the relationship between this nominal income and demand for money is positive. So as I said, so if nominal income increases, that means more transactions, that means more demand for money because of transaction. The second part, which is, again, it's the interest rate. The negative sign here just tell us that there's a negative correlation between, or negative relationship between, the interest rate and demand for money. An increase in the interest rate will decrease the demand for money, as we explained before, that because that means more people will put their wealth into bonds rather than money, because they will receive the high interest rate. So we could represent this graphically. We said as a macroeconomist, you have tools to explain your model. One is to use algebra, the other one is to use graphs. So as a graphical representation of this relationship, so what we have here, we have money on the horizontal axis and the interest rate on the vertical axis. And we know that, so this is the relationship between the demand for money and interest rate. And now this relationship is negative. So that means this curve should be downward sloped curve, which is what we see now. Because for different levels of I or interest rate, that means you're moving on the same demand for money curve. But if income, nominal income, has changed, you don't see nominal income on either axis. So that means this is something outside this relationship. So that means it will definitely cause a shift in the demand for money curve. And that means the MD curve. And that means if nominal income increase, that means the whole curve will shift to the right. Again, why would the curve shift to the right? Because the change of nominal income. So different levels of interest rate at the same or at a given nominal income. So that means you'll be moving on the same curve. But if nominal incomes change, in this example, what you see on the screen is an increase in nominal income. So that means this will move to the right, will shift the whole curve to the right. And again, that means at the same or for the same level of interest rate, you would have more demand for money. And why? Why would we expect that more demand for money? Remember, because one of the factors we talked about is the transaction demand. So higher income, higher level of nominal income means people will demand more money for transaction. And that's exactly what you see on the screen now. So having this shift to the right because of an increase of nominal income, that means more demand for money here. And again, we understand that because of transaction demand. So this is the one side. Remember, we started with financial markets. We split this into two, or we divided this into two markets. We said we'll focus on money markets, and we want to understand equilibrium in the money markets. And to understand equilibrium in any market, you need to understand demand and supply. So we started with the first side. Now we'll move to the second side. So just before I move to the supply side, I hope now the demand side is very clear. There are three reasons why you would need money: transaction demand, and then precautionary demand and speculative demand. So we have two factors that can determine this demand for money. One is nominal income, and it's positively related, and interest rate. To plot the demand for money curve, so we plot the relationship between money or demand for money and interest rate. And this is a downward slope curve. And if you change for any given nominal income, you basically, and you change the interest rate, you're basically moving on the same curve. But if nominal income itself has increased or has changed, that means this will shift the whole curve either to right if nominal income has increased, or to the left if nominal income has decreased. Now, let's think of equilibrium now. But before I think of equilibrium, really I need to understand money supply. Take money supply given by central banks, because monetary authorities or central banks, they decide what to do with money supply. So in this sense, money supply will be treated as exogenous to us here in this model. Okay? It's given by central banks. That's why we will plot on the same axis, we will plot money supply as a vertical line, because it's independent, it's not related to interest rate, it's actually given by central banks. So central banks decide how much money to inject in the economy. So to our model, it's exogenous. And we explain what that means. It is determined outside the model, and in this case, it's determined by central banks. So we take it as given, and that's why we'll call money supply, MS here means money supply equal M. So M is just a constant or some kind of given level of money supply. Equilibrium in any market when demand equals supply. Equilibrium here would happen in the money market, requires that money supply equals the demand for money equals M, and M here again we're taking it as exogenous because we know that central banks decide, we took the money supply provided by central banks as given. The condition is very simple. So equilibrium in the money market happens when money supply equals demand for money. Plot the money supply curve, we plot a vertical line, so it's not really related by the interest rate, and it's just giving to this analysis, it's giving to us. An equilibrium here will be at the point where these two money supply and demand for money curves intersect, which is this point A, and that will determine the level of money, M here, and the level of interest. So think of the interest rate here as the price of money. Okay? So it's demand and supply, and this is just easy like any other good, and you have a good called money, and this is the equilibrium between demand and supply, and this is the price of money, which is the interest rate. Now, let's just think of what would change this situation. There are two reasons now, or one of two reasons if they happen, this level of interest rate might change. One, if there's a nominal income increased, so we said that demand for money will shift to the right. Or if nominal income decreased, that means demand for money curve will shift to the left. Obviously, that will change the interest rate. And also, if central banks decided to change money supply, if central banks decided to increase money supply, so that means straight line, that vertical line, will shift to the right. And if central banks decided to reduce money supply, that vertical line will shift to the left. And that will tell us what would happen to the interest rate. The first case, looking from the demand side, which we already understand, if nominal income has increased. That's the case you see on the screen now. So the effect of an increase in nominal income, how that will affect interest rate. So remember, money supply is given by the central bank, so this vertical line is not going to move, and the effect of the change in nominal income will be reflected in a shift of demand for money curve, shift to the right because the change here was an increase in nominal income. When this shift to the right, so that means where's the equilibrium now? The new equilibrium point is A prime, which give us a higher level of interest rate. So this is where the equilibrium is set in the market. How interest rate will change if money supply itself change, so that vertical line moves. This is actually the job of central banks. Central banks set their monetary policy or manage monetary policy by basically changing money supply. So we will see how this works now. As we said, central banks set the monetary policy by adjusting the level of money supply, and that's why we call money supply here a monetary policy instrument. For a given money, demand for money curve, if the central bank decided to increase money supply, then this vertical line will shift to the right. And if they decided to reduce money supply, this vertical line will shift to the left. And this, of course, will change the equilibrium interest rate. So if the central bank increased the money supply and the vertical line shift to the right, that means the equilibrium interest rate will fall. And if the central bank decided to reduce money supply, and that means the vertical line or the money supply line will shift to the left, and that means interest rate, the equilibrium interest rate will increase. So this is an example of an expansionary policy where the central bank decided to increase or expand the money supply from M to M prime. So that means this vertical line shifts to the right. The initial equilibrium for the interest rate was at A, which is I level here, this I. And now after increasing money supply, the new equilibrium point became A prime, and that gave us a lower level of interest rate. So that means the interest rate will fall as a result of an expansionary monetary policy, meaning that the central bank decided to expand or to increase the money supply. How do central banks do that? How do they increase or decrease money supply? We treated money supply as given. We said this is given by central banks, but we really want to understand how do central banks do that. Central banks do this changing money supply. So again, this is the essence or the core of monetary policy, is changing money supply. How do central banks do this? Central banks do this through open market operations. So they go in the bond market and they sell or buy bonds. If they want an expansionary monetary policy or increase or expand money supply, so basically they would buy bonds. So when they buy bonds, they take bonds and they give money. Okay, they print money. Okay, so that means they increase the money supply. The other way, if they want a contractionary policy, that means they will sell. So they enter the bonds market to sell bonds. This will explain how this shift happened here. So if they buy bonds, that means they're expanding or increasing money supply. This line will shift to the right. If they sell bonds, that means money supply will fall. That means this curve or this line, this vertical line will shift to the left. And now we understand how this will affect interest rate, of course. This is just an example of the balance sheet of the central bank. And it shows that bonds here are on the asset side, while money is on the liabilities side. And it shows you on the second part, this part here, it shows the effect of an expansionary policy where they increased money supply by buying bonds. So which means you'll see here $1 million. This is how much change in bond holding, and this shows you the change in money on the other side. To summarize what we said here, we focused on the money market. We wanted to study the demand side and the supply side, and equilibrium happen when these both sides meet. So the supply side we took as exogenous, is given by monetary authorities or central banks, and we know now using open market operations, central banks can increase or decrease money supply by entering the bonds market as seller or buyer. Just as a final point here, rather than changing money supply, central banks can actually choose the interest rate they want, and then they adjust money supply accordingly. And this is another monetary policy instrument. It's just to use the interest rate as the policy instrument, and then based on that you could actually adjust money supply accordingly. And that's what typically most modern central banks do these days. So they choose interest rate and then they adjust money supply accordingly.